Hi, and welcome back to my channel. Today's question is, can my portfolio really stay strong amid both an AI boom and recession risk? And just a reminder, if you want to submit your own questions, you can do so through the comments section. All right, so this is a great question, and I think it's one that a lot of investors are concerned about right now. We have two major issues weighing on the markets right now. Number one is rising interest rates and slowing growth, which is causing a more recessionary environment. And then number two is the rise of artificial intelligence, which has caused a rotation out of growth stocks into more AI-related companies. So today we're going to talk about both of these issues, how they're affecting the market, and what I believe will happen next. First off, let's talk about the recession risk. Now, a recession is typically defined as 2 consecutive quarters of negative GDP growth. And according to the Atlanta Fed, the probability of a recession in the US over the next 12 months has been increasing. As you can see, back in June, there was only a 13% chance of a recession in the next year. But fast forward to today, and that number has increased to around 45%. This is due to a variety of factors, including rising interest rates, geopolitical uncertainty, and of course, the recent banking crisis. However, despite this elevated risk, I don't think we should be overly concerned. A recession is a normal part of the business cycle, and it doesn't necessarily mean that the economy is in trouble. In fact, recessions often lead to a period of economic growth known as an expansion, which can last for several years. The key is to ensure we're prepared for a potential downturn, allowing us to capitalize on any emerging opportunities. And that's exactly what we're doing with the portfolio. We have a well-diversified portfolio, the focus on quality companies that have strong fundamentals and a history of weathering economic downturns. This includes companies like Nestlé, which produces everyday essentials such as food and beverages, Colgate, which produces personal care products, and Procter & Gamble, which produces a wide range of consumer goods. These companies are well positioned to continue growing even in a recessionary environment because their products are in demand, regardless of the state of the economy. In addition, we also have exposure to technology companies such as Microsoft and Apple, which have a history of innovation and are well positioned to capitalize on long-term growth trends, such as cloud computing and artificial intelligence. Sure, these companies may see some short-term headwinds due to a potential recession, but we believe that their long-term growth prospects are still intact. The final thing that we're doing to prepare for a potential recession is making sure that we have a healthy amount of cash on hand. We currently have around 20% of the portfolio in cash, which we can use to take advantage of any opportunities that may arise. Overall, we feel good about the portfolio's resilience in a potential recession, and we're comfortable with our level of risk. Now, let's talk about the AI boom. Artificial intelligence is rapidly changing the world around us. From self-driving cars to personalized medicine, AI has the potential to revolutionize almost every industry. One of the most obvious impacts of AI has been on the tech industry. Companies that are developing AI-powered products and services are seeing huge increases in value. For example, NVIDIA, which produces graphics processing units that are used to train AI models, has seen its stock price soar by over 200% in the past year. Now, while this has been great for investors who have been able to capitalize on the AI boom, it's also created a bit of a problem. The rise of AI has caused a rotation away from growth stocks towards more AI-related companies. This has resulted in a significant amount of money flowing into funds that specialize in AI, which has caused the price of AI-related stocks to skyrocket. However, this has left investors who are not focused on AI or growth stocks feeling left behind. So what does this mean for the portfolio? Well, we've been carefully monitoring this trend, and we've decided to make some changes. To ensure that we're well positioned to take advantage of the opportunities that lie ahead, first, we've been adding exposure to companies that are benefiting from the rise of AI, such as Microsoft, which is integrating AI into its products and services, and Google, which is investing heavily in AI research and development. Second, we've been reducing our exposure to companies that are not keeping up with the latest AI advancements. For example, we've been selling our positions in banks such as JP Morgan and Wells Fargo, which face significant competition from fintech companies that are leveraging AI to offer better products and services to customers. By making these changes, We're ensuring that the portfolio is well positioned to benefit from the rise of AI, while also mitigating the risks associated with companies that are not keeping up with the latest advancements. It's important to note that this is not a one-size-fits-all approach, and what works for one investor may not work for another. It's crucial to consider your own financial situation, investment goals, and risk tolerance when making investment decisions. Additionally, it's important to stay informed about the latest market trends and economic developments, as they can have a significant impact on your portfolio. And finally, it's always a good idea to consult with a financial advisor who can provide personalized guidance based on your individual circumstances. Now, to be clear, I'm not saying that AI will have a positive impact on everything. There are certain industries that could be negatively impacted by AI, such as those with repetitive tasks. For example, if AI becomes more advanced and capable of performing more complex functions, it could potentially replace certain jobs in various industries. For instance, in the transportation industry, the rise of self-driving cars could potentially lead to job losses for truck drivers and taxi drivers as these roles become automated. Similarly, in the manufacturing industry, the use of AI-powered robots and automation could potentially lead to job losses for workers who perform repetitive or routine tasks. It's important to keep in mind that technological advancements have historically led to job displacement, but also the creation of new jobs. For example, the rise of personal computers in the 1980s and 90s led to job losses in the early stages, but eventually created new jobs in fields such as computer programming and software engineering. However, it's possible that the impact of AI on the job market could be more significant than in previous technological revolutions. As AI has the potential to automate a wider range of tasks across more industries. What do you think, though? You think the benefits of AI outweigh the risks? Comment below. Overall, we're cautiously optimistic about the future of the markets. While there are certainly risks to be aware of, such as a potential recession and the rapid advancements in AI, we believe that the long-term growth prospects for the economy and the stock market remain intact. That's why we're staying committed to our investment strategy of focusing on quality companies with strong fundamentals and a history of innovation. Remember that investing involves risk, and past performance is not indicative of future results. But we're excited to continue investing in the markets and sharing our journey with you. Thank you for watching, and if you haven't done so already, we'd appreciate if you could hit the like button and subscribe for future updates. Thanks again, and until next time.